You have a brilliant business idea, but now you're stuck on the most boring yet dangerous question. How do I register this? Choose the wrong structure today, and you could end up paying a flat 30% tax when you could have paid zero. Or worse, you could block yourself from ever raising funding when you need it most. Don't gamble with your business's legal foundation. Hello and welcome to Business and Tax. I'm your host, CA Kashif. Today, we are settling the ultimate debate for every Indian entrepreneur. It's a fatal four-way match: sole proprietorship versus private limited versus LLP versus one-person company. We'll compare them on tax, compliance, and funding to help you decide which one is perfect for you in 2025. If you want to skip the headache and let experts handle your registration, you can contact us to purchase our professional services regarding documentation. The links are given in the description. Now, let's enter the ring. Round 1. The basics and ownership. First, let's define our contenders. The sole proprietorship. This is the solo player. It's the simplest form of business. You are the business. There is no legal difference between you and your shop. The private limited company, Pvt Ltd, this is the gold standard. It's a separate legal entity, widely trusted, and allows you to have shareholders. You need a minimum of 2 directors and 2 shareholders to start. The LLP, Limited Liability Partnership. Think of this as a hybrid. It gives you the safety of a company, but the flexibility of a partnership. You need a minimum of 2 partners here. The OPC, one-person company. This is for the solo founder who wants a corporate tag. It lets you register a company with just one person, but it comes with heavy compliance. Round 2, the wallet test, compliance and cost. How much will these cost you every year? The sole proprietorship is the undisputed winner here. Why? Because it has almost zero compliance costs. You don't need a separate audit unless your turnover is huge, over 1 crore or 2 crores depending on the case. You just file your personal income tax return. That's it. The LLP is the runner-up. Compliance is low. You don't need a mandatory statutory audit unless your turnover crosses 40 lakhs or capital contribution crosses 25 lakhs. Pvt Ltd and OPC are the most expensive. Even if your turnover is zero, a private limited company and an OPC must undergo a statutory audit every single year. You have to pay a CA for the audit, file ROC forms, and hold board meetings. An OPC might look like a small business, but its compliance bill is almost the size of a big company. Round 3. The tax test, the crucial difference. This is where 90% of people make the wrong choice. For beginners, profits under 10 to 15 lakhs, sole proprietorship wins here. Why? Because as a proprietor, you are taxed at slab rates. Under the new tax regime, your income up to 3 lakhs is nil, and rates increase gradually. If your profit is 12 lakhs, you essentially pay zero tax due to rebates. Compare that to an LLP, which pays a flat 30% tax on the very first rupee of profit. Ouch! For high profitability, profits in crores, private limited wins. Domestic companies can opt for a concessional tax rate of 25% plus cess. This is far better than the 30% slab rate for high-income individuals or LLPs. What about double taxation? In a private limited company, you pay 25% corporate tax. But if you want to take that profit home as a dividend, you have to pay tax on that dividend again personally. In an LLP or sole proprietorship, the profit after tax is yours to keep. No double tax. Round 4. The vision test, funding and risk. This is the tiebreaker. Do you want to raise VC funding? If yes, close your eyes and pick private limited. Investors rarely fund LLPs or proprietorships because they want equity shares. They also avoid OPCs because an OPC cannot have more than one shareholder. Are you worried about personal risk? In a sole proprietorship, your liability is unlimited. If the business goes bankrupt, the bank can sell your house and car to recover the money. In Pvt, LLP, and OPC, your liability is limited. Your personal assets are safe even if the business fails. Conclusion, the final verdict. So here is your cheat sheet. Choose sole proprietorship if you are a freelancer, shop owner, or just starting out with low investment. It saves you money and tax. You can always convert to a company later. Choose LLP if you have a partner and run a service business like an agency or consultancy where you want to save on compliance but need safety. Choose Pvt Ltd if you're a startup aiming for high growth, huge scale, and VC funding. Choose OPC only if you are a solo founder in a high-risk industry and absolutely need limited liability but can't find a second director. Otherwise, avoid it due to high compliance costs. Outro. Choosing the right structure is the first step to building a legacy. Make sure you build yours on solid ground. If you need help deciding or handling the paperwork, remember, you can contact us to purchase our professional services regarding documentation. The links are given in the description. If you found this comparison helpful, hit that like button and subscribe to Business and Tax for more practical financial wisdom. I'm CA Kashif, signing off. See you in the next video.